take up revision for one of the very crucial topic of advanced accounts, paper 5 of CA Inter. That is internal reconstruction. One of the lengthiest of the questions. If you count a list of lengthiest solutions, this can be one of them. Why? Because you must have seen the questions having at least 10 to 12 adjustments, requiring journal entries, and then question telling you prepare revised balance sheet. Students, what is internal reconstruction? A company, the management thinks that our company has suffered with huge losses and constant accumulated losses. The balance sheet is consisting of many of the dust in the sense that asset side has all fictitious assets, artificial assets, deferred revenue expenditures, accumulated losses, but the liability side are genuine liabilities. So management wants to reconstruct the balance sheet, reconstruct the company, and reconstruct the company without any outside reconstruction. I mean, they don't want to go for external reconstruction. They don't want to create a new company. They want to maintain the existing company, but do the reconstruction within it. Sweep out the dust of the balance sheet. And that is what you call it as internal reconstruction. Students, a temporary account is opened called as capital reduction account. Some people also call it as internal reconstruction account. Some people call it as reconstruction account. More advisable is to write capital reduction account. So all the things, whatever you are going to do in the part of internal reconstruction, you will do it with the help of capital reduction account. I shortly call it as CR account. For example, balance sheet asset side, there is an accumulated loss, P&L debit balance. We have to write it off. It has a debit balance. To write it off, we have to credit it. So my entry will be to P&L account. The debit will go to capital reduction. Question might be having some intangible assets which are of no use, like goodwill. Write off goodwill. Entry will remain same. Capital reduction account, debit to P&L, to goodwill, intangible asset written off. This kind of all fictitious assets and artificial assets should be written off. Management thinks, let us take a chance to revalue the assets, the other genuine assets. If any of the asset value is going up, the entry will be asset account, debit to capital reduction account. Very much possible value of any of the asset is coming down. Reverse entry. Entry will be capital reduction account, debit to asset account. Clearing on the liability side, say trade creditors, accounts payable. Some of the creditors said that, okay sir, you are passing through financial crisis. We are waiving off, we are forgetting our 30%. So creditors are coming down by 30%. Creditors are a liability. If they have to be reduced, they should be debited because normally they have a credit balance. So my entry will be creditors account, debit to capital reduction account. Debenture holder says that our rate of interest, which is 9%, if you make our debentures of 9% to 11%, we will waive off interest accrued, which you have not given us. Company says, okay, done. So first entry will be to convert 9% debentures to 11%. Simple rule, keep it in mind, old to new. So it will be 9% debentures, old account debit to 11% debentures, that is new account, right? When you go ahead with 9% to 11%, they said that our interest accrued is waived off. Interest accrued is a liability for the company. It will be having a credit balance. Now it is to be washed off, so I debit it. So my entry will be interest accrued on debentures account debit to capital reduction account. Preference shareholder says the preference share capital, that at present our capital is 1 lakh shares of rupees 10 each, fully paid up. They said do one thing, keep it 1 lakh shares, face value also intact 10 each, but make it 8 paid up. So reduction in the paid up value, 1 lakh, and paid up value coming down by 2, so 2 lakhs. Preference share capital is a liability having a credit balance. Now that is to be reduced, so we should debit it. So my entry should be, say for example they are 8% preference share, so 8% preference share capital account debit to capital reduction account, reduced by what amount? 2 lakhs. Be very watchful, this is reduction in paid up value I had shown you. For equity share capital I am showing you reduction in face value. Suppose for equity share capital, the old capital is 1 lakh equity share of rupees 10 each, fully paid up, and equity shareholder says that okay, do one thing, make it 1 lakh equity share of rupees 8 each, fully paid up. So they are reducing their face value from 10 each to 8 each. Preference share capital I told you, reduction in paid up value. This is reduction in face value. Entry will be slightly changing. Old capital will be debited, new capital will be credited, and difference will transfer to CR. So my entry here will be equity share capital account, which was of rupees 10 account debit, 1 lakh into 10, so that was 10 lakhs. 2. Equity share capital with a new one, 8 account, that will be 8 lakhs. And 2. Capital reduction account, that will be 2 lakhs. So equity share capital debit, 2 equity share capital and 2 CR. I'll pay focus now on a contingent liability. You all know contingent liability is unrecorded liability. Liability shown as a disclosure, footnote to balance sheet, having no place in books of account. Suppose question says that preference shares, which are cumulative preference shares, there is arrears of cumulative preference dividend, say 5 lakhs. And preference shareholder says that this 5 lakhs we are waiving off completely. We don't want a single naya paisa out of this 5 lakhs, completely waived. Then the error on the part of students, what they do, they think that, oh, 5 lakh was payable, now it is not payable, so it's a gain. So they credit capital reduction account. But please mind well, it was a contingent liability having no place in books of account. Something which was not there in books of account is not payable also. So the one which was not there in the books is no more payable. That means there is no journal entry for this. So waiver of a contingent liability There will not be any journal entry. Next, they say, okay, out of 5 lakh, we are settling our contingent liability at 2 lakhs. Give us your new equity shares which are of 8 rupees. So our company, instead of 5 lakhs, is paying 2 lakhs to settle the contingent liability. Here also students make some mistakes. Student says, oh sir, it's a gain. Against 5 lakhs we are giving them 2 lakh. But no, my dear, it's a loss. 5 lakh was a contingent liability having no place in books of accounts. A liability which was not there in books of account, and you paid 2 lakh for it. So apparently it's a loss for you. The liability which was having a zero value, we are paying 2 lakhs. That too in terms of equity share. So it's a loss for you. Entry for loss. Capital reduction account debit, and you are paying them in equity share of rupees 8. So equity share capital, rupees 8 account, amounting to 2 lakhs. That was for contingent liability. Whatever is given in the question, we have to follow it. Go on passing journal entries. After passing all entries, prepare a working note showing a clear posting in capital reduction account. After you make all postings in capital reduction account, the totaling of capital reduction account can have two outcomes. It can have a credit balance or it can have a debit balance. If it's a credit balance, you can call it as a gain because of internal reconstruction. And this gain is an exceptional gain, non-recurring gain. It's not going to come again and again. And you all know, exceptional gain has to be transferred to capital reserve. So if it's a credit balance, my journal entry will be capital reduction account debit to capital reserve account. But as it is a debit balance, a loss, then point number 1, question will give you a hint directly or indirectly. Follow that hint. So follow instruction of the question. For example, question will say one of our land and building is highly undervalued. So it's a clear hint that this debit balance will be utilized for appreciating the land and building which is highly undervalued. One or other hint may be indirectly available. And in a rare case, if there are no hint available, this loss, debit space a loss, has to be debited to equity share capital account. They are the real owners of the company, so they have to bear it. So in that case, the entry will be equity share capital account debit to capital reduction account. And at that time you can easily write a footnote that in absence of any information, the debit balance of capital reduction account has been transferred to equity share capital account. Normally they don't keep any kind of such things hidden, but if it is hidden something, when question, even if you try, if nothing has been specified, then give effect of it. As I told you, minimum 10 to 12 adjustments. Writing of fictitious assets, writing of goodwill, upward revaluation of asset, downward revaluation of asset, creditors waiver, debenture holders waiver, their change of rate of interest, change in face value or paid up value of preference share capital, change in face value or paid up value of equity share capital, one or two other adjustments like expenses for internal reconstruction scheme. Expense, so it's a loss for us. Entry will be capital reduction account debit and you are paying expense to cash bank. One by one, slowly you should take adjustments, go on passing entries. Last summary, prepare a working note called as capital reduction account, make the balance. Narrations, whenever you write, essential, advisable. Suppose you are writing of fictitious asset, then being accumulated loss written off under scheme of internal reconstruction. So these kind of words can come like under scheme of internal reconstruction. Everywhere in every narration you should have those words. This is an overall view. Different varieties are also possible under internal reconstruction. You have one more, that is points of out a particular debenture holder, a particular creditor, etc., etc. Every question has to be dealt with on its own merit. Typical adjustments, yeah, common adjustments I discussed with you, but some typical adjustments has to be discussed, and that we'll discuss now. One more variety what you have in internal reconstruction is share surrender. That is surrender of equity shares by equity shareholders back to the company. Now, you know what happens is that at the time when the company goes for internal reconstruction, creditors are ready to waive something, debenture holders are ready to waive something, but in return they want their account to be settled. If creditor says that I am waiving off 30%, he always wants the remaining 70% has to be paid to him. Now, our company found itself in a position that there is no liquidity with us. So, we can't pay them by cash or check. Another option, we decided that let us issue them our shares, but we found that all our authorized shares are already issued. So, that option is blocked off. The last option is this one. Company will request equity shareholders, the dear equity shareholders, you are the owners of the company, kindly surrender some of the shares back to the company so that company can reissue them to creditors and debenture holders to settle their claim. Thereby waiver's benefit can be received by the company. So what entries can be passed at the time of surrender of equity shares, that we are trying to understand. Entry number 1, for share surrender. Company will get back equity share capital, so that will be debited. Entry will be equity share capital account debit to share surrender account. Now, from this share surrendered back to our company, company will reissue them. Now, equity shares are surrendered, they are cancelled now. What does it mean? They don't remain now as equity share. Their identity as equity is lost, they are cancelled. Now, they can be reissued either as equity share, they can be reissued either as preference shares. Mind well, equity shares are surrendered and reissued as preference shares does not mean conversion of equity share into preference share. You should not do that accounting of conversion of equity shares. Simple, when equity shares came back, they are cancelled, their identity is lost. So, our company can very well reissue them either as equity or as preference. So, first entry for share surrender. Entry number 2, for reissue of surrendered shares. Our company can reissue them to debenture holders, to creditors, etc. Entry, the reverse entry definitely. So, entry will be share surrender account debit to If it is issued as equity share capital, then 2 equity share capital. If they are reissued as preference shares, then 2 preference share capital. Now suppose creditors were 5 lakhs. Creditors said that we are waiving off 40%. 40% of 5 lakh means 2 lakh is their waiver, but give us 3 lakhs. So our company, for example, has reissued 3 lakh rupees of shares to creditors. They were 5 lakhs, we gave them only shares of 3 lakhs and they are settled. At this point, students makes misunderstanding. What students does is, the creditors were 5 lakh, we gave them only 3 lakh, so gain is 2 lakh. They transferred to capital reduction 2 lakh. But the fact is, the gain is total 5 lakhs. All 5 lakh of creditors are getting 0. You are settling them with those equity shares or those preference shares which your company got free of cost as surrendered from the shareholders. So this costed you nothing, and the one which is costing you nothing, free, you are able to reduce the creditors to 0. So gain will be all 5 lakh rupees of creditors. For example, so entry number 3 will be settlement of creditors. When you talk about settlement of creditors, the payment will be, creditors are getting nullified. So creditors will be debited. Entry, creditors account debit 2. It's a gain. Capital reduction account. Likewise, we will issue some of them to debenture holders. They will be getting settled, so on and so forth. Whatever is given in the question, pass those entries. Out of shares surrendered, reissue them. At the end, if there is any balance still left in share surrender account, then close share surrender account and transfer the balance to capital reduction account. So step number 4 will be balance of share surrender account will be transferred to capital reduction account. Entry, share surrender account debit to capital reduction account. So this is the way the entries has to be passed by you for share surrender. That's the second variety to be taken care of. Initially all entries through capital reduction I taught you. Typical variety, surrender of equity shares. Entries to be passed I discussed with you people. Yeah, at the end share surrender account should be closed and transferred to capital reduction. Balance of capital reduction will be transferred to, lastly, capital reserve account if it's a credit balance, if it's a debit balance, I already discussed with you people. So that was the point regarding surrender of shares. We discuss one more variety. See, all internal reconstruction, some whatever are typical things I am trying to discuss with you people. So you have very clear vision that yes, this can be typical items that can be asked. Question number 4 of our textbook, Repair Limited. The question is giving you a kind of statement of the receiver. This is not the balance sheet. Intentionally question is drafted in such a way that heading is liability and asset and all that. But when you go into the heads itself, you will realize that this is not balance sheet. Repair Limited is in hands of receiver of debenture holders who holds a charge on all assets except uncalled capital. The following statement shows position as regards creditors as on 30th June 2011. Liabilities and assets. If you see the liabilities, 6,000 shares of 60 each, 30 paid, and there is no amount against it, you can say. So all these things given to you, if you see the asset side, property, plant, cost is here and their estimated value is given there. Then some deficiencies are available here. Something surprising, uncalled capital is here. So these things given to you apparently indicate to you that these are not balance sheet. So in such sums, your first job will be to prepare in the solution a balance sheet. A balance sheet, simple, liabilities and assets, horizontal balance sheet, no need for vertical balance sheet. And there you will always find that a liability will be more than assets. The balancing figure on the asset will be profit and loss, accumulated loss. And that accumulated loss, you know it very well, has to be written off to capital reduction account. So whenever any question is such where balance sheet is not given, it's a hint given to you that kindly prepare first the balance sheet. The difference, if it is in the liability, make it as reserves and surplus. If it is in the asset, accumulated loss. That's a hidden adjustment. And that accumulated loss has to be written off to capital reduction account. First typicality. Second, question is giving you detail about Mr. A and Mr. B, who are debenture holders, creditors as well as shareholders, and their settlement. See, Mr. A holds first debentures of 3 lakh and second debentures of 3 lakh. So he is a debenture holder. He is also unsecured creditor of 90,000. B holds second debenture for 3 lakh and is unsecured creditor for 60,000. And now how they are settled? Following scheme of reconstruction is proposed. A is to cancel 2,10,000 of the total debt owing to him, to bring in 30,000 cash in the company, and to take first debenture in cancellation of those already issued to him for 5,10,000 in full satisfaction of claim. So whenever they give you this kind of situation, you have to prepare a very clear working note. Now see, the working note for A I can prepare in this way is calculation of settlement of Mr. A. Now, amount due to him, whatever company is supposed to pay him. Question says A holds first debenture of 3 lakh. So we have to pay him 3 lakh rupees towards first debentures. Second debentures also of 3 lakhs. So we have to pay him towards second debentures another 3 lakhs. He is also unsecured creditor of 90,000. So he is one of our trade creditors of rupees 90,000. Okay, there is unsecured creditors. $90,000, nothing else. What does it mean? Total our company is liable to pay him 6,90,000. And now read the first adjustment. How is that 690 settled? A is to cancel 2,10,000 of his total debt. So out of 690, he is waiving off. So there is a waiver. Waiver of how much amount? 210. That means now we have to pay him 4,80,000. To bring 30,000 in cash, he is giving our company 30,000. Means we have to give him, refund him, pay him 30,000. So 4,80,000 plus cash received from him 30,000 So our company totally owe him 5,10,000. And how are you paying him 510? And to take first debenture in cancellation of those already issued to him, the old first debentures are cancelled for rupees 5,10,000. So again 5,10,000 against that minus first new debentures of 510 and his account is settled. Now when you think about the journal entry for this one, yes sir, how can we go for such a big journal entry? Answer is simple. Whatever was payable to him becomes our liability, and those liabilities are settled now. Liability always has a credit balance, you are getting it settled, so we should debit them. So if a journal entry is to be passed towards this, what should be the entry? My entry will be first debentures account debit 3 lakhs, second debentures account debit 3 lakhs. We are also settling unsecured creditor with him, students. Unsecured creditors account debit 90,000. Plus he is bringing cash to us, cash is coming in, debit what comes in. Cash account debit, he is bringing 30,000. 2. Waiver will be credited to capital reduction account, he is waiving 210. And then we are giving him new first debenture, so 2. First new debentures of 5,10,000. Got it, everyone? This was for A, something similar working note you can prepare for B. What is one thing more important in this sum is language about settlement of remaining creditors. See, this adjustment 3. Unsecured creditors other than A and B agreed to accept 4 shares of 7.50 each, fully paid. 4 shares, 1 share of 7.50. When you multiply, it comes to 30 rupees, right? In part satisfaction of 75% of every 60 of their claim. So if our company has to pay them 60, they are settling 75% with us. So the way the working note can be prepared is, if an unsecured creditor, our company owes him 60, out of 60, the creditor is settling 75%, means settled 75%. That means in future the balance still payable is 25%. Calculate 75% of 60 is rupees 45. 25% of 60 is rupees 50. What we read just now, how are you settling that 45 rupees? By giving him 4 shares of 7.50 each. So against 45 rupees, our company is issuing them shares, means equity share capital. 7.50 per share, and that kind of 4 shares. So against rupees 45, you are giving them only rupees 30 as a consideration. What does it indirectly mean? That remaining 15 is waiver. Now all this working note what I prepared, students, was keeping in mind a base of rupees 60 as a figure. But you all know, friends, you cannot have a creditor of 60 rupees. So we now convert this 60 rupees in actual terms. Read, look into your question. Okay, it says the balance of 25% is to be postponed and to be payable at the end of 3 years. So this balance 15 rupees will be payable at the end of 3 years. Indirectly it means that this creditors now will not be current liability. Their period is 3 years. That means they are coming under the head non-current liability. Let me now write the actual figures. If the sum can be seen, your total creditors here were 4,50,000. Out of 450, Mr. A was creditor of 90,000 and Mr. B was creditor of 60,000. 90 and 60, 150 settled. Total was how much? 450. 150 settled. Is this working note what I am preparing? This 60 is actually rupees 3 lakhs. Now becomes easy a job of calculator. Out of 3 lakh, 75% is settled. So this 45 is nothing but 2,25,000. This 25% of 3 lakh will be rupees 75,000. That 75,000 will come in our new balance sheet called as non-current liability. You all know when you prepare a revised balance sheet in internal reco, along with the name of the company, we must write and reduced, statutory requirement, compulsory. This 2,25,000, which is equivalent to 45, you are giving 30 rupees settlement in terms of equity shares. So against 2,25,000, 30, what does this mean? Cross multiplication. The equity share capital will come to 1,50,000 and remaining 75,000 will be the waiver. Simple use of calculator, nothing else. You kept 60 as a base and the whole chart is ready with you. So this question number 4 and immediate next question, question number 5 in our textbook, they are worth revising a day before your exams. It has some typical points in it to be taken care of by you. I don't say other questions doesn't have typical points, but they're the routine ones. Every sum has those things. But this typical things, preparation of balance sheet before you start with the solution, settlement of A, settlement of B and settlement of other creditors. Particularly question number 4, that 60 rupees adjustment is much more typical, because if one place you make a mistake, you are gone for the full solution, friends. And you have to be very, very watchful. So one was share surrender, second is about this variety. Enough number of sums are available in our textbook. All past paper sums, typical homework sums. Practice whatever you can do. Enough study material is provided to you. But care is to be taken. The typical points which I am discussing here should be there on the back of your mind when you enter exam auditorium. So this was a basic view. All sums normally we have seen: past journal entries, prepare balance sheet. Past journal entries, prepare balance sheet. At the most, one ledger account, working note, capital reduction account. If it's a share surrender, 2 ledger account, share surrender account and capital reduction account. I will now be discussing with you people, student, a typical sum in IPCC paper. IPCC is an old course, but that does not mean old course means what? Chapter remains the same. A fabulous question asked by them, requiring you to prepare ledger accounts and even a typical adjustment of valuation of investment. So, I will now be discussing with you people that sum of IPCC paper January 21, that is November 20 opt-out paper of paper 1. In IPCC, internal reconstruction was there in both groups, paper 1 as well as paper 5. A typical sum, unique in its own variety in so many years, if IC has asked, was this sum. So, it is worth discussing with you people. I will discuss that with you people. We see that sum of IPCC paper January 21 opt-out group 1, that is paper 1. The second question of that concerned paper, balance sheet of Y Limited as on 31st March 2020 was as follows. Particulars, note and amount, equity and liabilities, shareholders funds, 1,28,000 equity shares of 10 each, 7.50 paid up, they are partly paid shares. 1,28,000 8% cumulative preference shares of 10 each, fully paid. Profit and loss account, and if you see the figure of profit and loss, it is given in negative, and negative means it is accumulated loss, by default has to be written off. Non-current liability is unsecured loan from directors. Current liability includes sundry creditors and bank overdraft. Assets, non-current assets will be freehold land at cost, plant and equipment at cost less depreciation means WDV, goodwill, long-term investments in shares in B Limited at cost. So, they are non-current investment. Current assets, inventories and debtors. So, point to be observed by you, the company does not have any cash and bank balance on the asset side. So, shortage of liquidity, and in addition you have a bank overdraft on the liability. The arrears of preference dividend amounts to 1,02,400. A scheme of reconstruction was duly approved with effect from 1st April 2020 under the conditions stated below. The unpaid amount of equity shares would be called up. So, final call you are calling up. Preference shareholders would forego their arrears of dividend. Contingent liability is foregone, no entry. In addition, they should accept a reduction of 2.50 per share. Dividend rate should be enhanced to 10%. Old preference share capital are 8%, the new one will now be 10%. Next one, equity shareholders would accept a reduction of 7.50 per share. This is a typical adjustment. Y Limited means we, our company, holds 21,600 shares in B Limited. This represents 15% of the share capital of that company. So, our company holds 15% of share capital of B Limited. B Limited is not a listed company. That means our investments stock market value we can't know because it is not a listed company. The average net profit after tax of the company is 5 lakh. So, that B Limited where we have done investment, that company's net profit after tax is 5 lakhs. The shares would be value based on 12% capitalization rate. And the most important adjustment it is for the valuation of our investment. See, investment in the balance sheet, the book value is 6,48,000. This adjustment will help you in finding the market value, the NRV. A bad debt provision at 2% should be created. Other assets should be valued as under plant and equipment, freehold land, inventories. The P&L account negative balance should be eliminated. Even if not said, we know it is a hidden adjustment. Goodwill would be written off. That is also hidden adjustment. Directors would have to take equity shares at a new face value of 2.50 per share in settlement of their claim on the loan. Equity shareholders, including directors who would receive equity shares in settlement of the loan, would subscribe to 2 new equity shares for every 1 share held in cash. Preference shareholders would subscribe 1 new preference share for every 4 preference shares held in cash. The new face value of shares, preference and equity, will be maintained at the reduced level. You are required to prepare, look at that, capital reduction account, equity share capital account, 8% cumulative preference share capital account, 10% cumulative preference share capital account, and bank account. And of course, the balance sheet is a routine job for you. So, I am showing you how to prepare those ledger accounts in the solution and how do we account for it in the solution. So, the ledger accounts are here in front of you. I will give heading ledger of Y Limited, which is undergoing internal reconstruction, capital reduction account, and all 5 accounts I have prepared. Before I start taking one by one adjustment, your first job will be to show the concerned opening balances. What do you mean by concerned opening balances? Now, capital reduction account cannot have an opening balance. Equity share capital, look into your question. 1,28,000 equity shares of 10 each, 7.50 paid up. So, that equity share capital amount is already given in the question to you, 9,60,000 rupees. So, that 9,60,000 will be equity share capital, liability. So, credit balance, buy balance brought down, 9,60,000. Then second account they said is to prepare 8% cumulative preference share capital account. Look into questions balance sheet. 1,28,000, 8% cumulative preference shares of 10 each, fully paid, 12,80,000. So here, by balance brought down, 12,80,000, right? Next, cumulative preference share is a new one, 10% pending. Bank account, and if you see the question, we have a bank overdraft. So, you have 2 options, either you show bank overdraft in cash and bank credit side as opening balance, or you can show bank overdraft directly as a liability in the new balance sheet. Both options are correct, both are acceptable by ICI. I am showing that as a credit balance, the opening credit balance, by balance brought down, 4,16,000. Now, we take one by one adjustments to show you the impact. There is a P&L in the balance sheet, accumulated loss of 9,76,000, that will be written off to capital reduction account. So, entry will be capital reduction account debit to P&L. So, to P&L account 9,76,000. Then question also says to write off goodwill 1,36,000. So, to goodwill account 1,36,000. So, these are apparent adjustments which are available on the face of the balance sheet. Adjustment 1 says arrears of preference dividend, no effect because that is to be waived off. Unpaid amount on equity shares would be called up. Equity shares are 1,28,000, 7.5 paid up. So, now 2.50, 1,28,000 into 2.50, final call 3,20,000, 2 entries. Equity share final call account debit to equity share capital. So, by equity share final call account. Number of shares, it is given to you 1,28,000 and call 2.50 per share. So 1,28,000 into 2.50, final call is 320. Second entry, receiving final call, bank account debit to equity share final call. So bank account debit side to equity share final call account, 3,20,000, receiving money. Second, preference shareholders would forego their arrears of dividend, no effect. In addition, they would accept a reduction of 2.50 per share. The dividend rate would be enhanced to 10%. So two things are changing. 8% cumulative preference shares, 1,28,000 shares are there. They are fully paid and they are accepting a reduction of 2.50. So 1,28,000 into 2.50, coming down by 3,20,000. Entry will be 8% preference share capital account debit. Here it is 2. The value is coming down, right? So 2 capital reduction account. 2 capital reduction account. 1,28,000 and 2.50. So 3,20,000. Second effect, 2 capital reduction. So capital reduction credit side by 8% preference share capital account, 3,20,000. Next, what else they are saying? After reducing this, dividend rate has to be enhanced to 10%. So this old preference share capital, which are of 8%, will no more be applicable now, and they will be converted into new preference shares which are of 10%. Come on, make balancing. Credit is more, 1280, subtracting the debit, minus 320. So my balance left is 960. 2, what percentage now? 2, it will be 10%. So 2, 10% cumulative preference share capital. So from 8% they got converted into 10%. Give second effect to 10%. So 10% cumulative preference share credit side by 8% cumulative preference share capital account of what amount? 960. Meaning thereby old 8% preference shares are now nullified. They are 0. Equity shareholders would accept a reduction of 7.50 per share. So go to equity share capital. They are 1,28,000 shares, now fully paid 10, and out of that they are reducing 7.50. Entry, equity share capital account debit to capital reduction account, 1,28,000 shares, and they are accepting reduction of 7.50 per share. So that comes to 9,60,000. 2 capital reduction, second effect, capital reduction credit side by equity share capital account, 9,60,000. Next, this important adjustment, valuation of investment. Y Limited holds 21,600 shares in B Limited. This represents 15% of the share capital of that company, B Limited. B is not a listed company. Average net profit after tax of the company is rupees 5 lakhs. The shares would be valued based on 12% capitalization rate. So, we prepare a simple working note for valuation of investment. Valuation of investment in shares of B Limited. Come on, first we find the capitalized value. So, capitalized value of B Limited company itself. Net profit is how much? Net profit is 5 lakhs. And they are to be capitalized at what rate? So, into 100 by 12. So, when you multiply this 5 lakh into 100 by 12, the value of company B Limited is 41 lakh 66,667 approximately. But we do not have all 100% of B Limited, we have only 15%. So, value of 15% of equity shares will be 15% of 41 lakh 66,667. So, that will be amounting to 6 lakh 25,000. So, in short, the revised value of our investment is 6 lakh 25,000. Look into balance sheet. What is the book value? The cost of it. The cost is 6 lakh 48,000. The book value or the cost is rupees 648. Revised value is 6 lakh 25,000. What does it mean? The value of investment is coming down by 23,000. Investment coming down is our loss. So, capital reduction account debit side. 2. Investment in shares of B Limited account 23,000. Bad debt provision of 2% should be created. So, 2 reserve for doubtful debts, or you can say 2 provision for doubtful debts, 2% on debtors. What is the amount of debtors given to you? Sundry debtors are 6 lakh 40,000, 2% will be 12,800. Other assets would be valued as under. Plant and equipment 2 lakh 80,000. Balance sheet is 480, so coming down by 2 lakhs. CR debit side. 2. Plant and equipment 2 lakhs. Next, freehold land 7 lakh 60,000. There are 2 lakh 80,000 given there. So, going up by 480 credit. So, by freehold land account 4 lakhs 80,000. Inventory is 5 lakhs, old value 496. So, going up by 4,000 again for us. So, by inventories account 4,000. Adjustment G, P&L account negative balance would be eliminated, done by us. Goodwill should be written off, done by us. Directors would have to take equity shares at new face value 2.50 per share in settlement of the loan. Directors loan is 1,20,000, and that we are satisfying by giving them new equity shares. So, we are issuing equity shares. So, in equity share capital it will come in the credit by director's loan. Loan amount is 1,20,000. One share now is of only 2.50. So if I calculate number of shares we issue, 1,20,000 divided by 2.50. So number of shares our company must have issued to discharge director's loan is 48,000. Next, equity shareholders, including the directors who have received equity shares in settlement of their loans, just now you calculated 48,000, would subscribe to 2 new equity shares for every 1 share held in cash. So fresh issue, entry, bank account debit to equity share capital account. How much? Originally we had 1,28,000 shares plus 48,000 shares just now issued by us to directors. 128 plus 48, so 1,76,000 shares multiplied by 2, because for 1 they have to accept 2, and multiplied by 1 share of 2.50 each. So 1,76,000 into 2 into 2.50. So amount received will be 8,80,000. Right. Second effect, by bank. So it will go to bank account debit side. 2, equity shares capital account, 8,80,000. Continue. Next, preference shareholders would subscribe 1 new preference share for every 4 preference shares held in cash. Come on. How many preference shares are there now? The old 8% has gone by. The new one are 10% preference shares. Okay. Number of preference shares in question's balance sheet was 1,28,000. And what is question telling you? The new face value. In fact, preference shareholders will subscribe to 1 share for every 4 preference shares. For 4 it is 1, and the new value is how much? New value of preference shares is from 10 rupee, the value has come down by 2.50, so 7.50. So preference share capital, fresh issue by bank account. Your amount is 960. Ratio is 1:4. Okay. So for 4 shares, 1 extra share. So for 960, how much? 1/4. That will be 2,40,000. Okay. Second effect, by bank 240. So bank account debit side to 10% cumulative preference shares capital account. Fresh issue, we received 2,40,000. Adjustment K is only additional information. Nothing else is left. We now have to close all the ledger accounts. The first account, capital reduction account. Debit and credit. When we make totaling, credit is heavier. The total of credit is 17,64,000. Writing same in debit, 1764. Subtracting debit, that's a gain which I must transfer to capital reserve account. So to capital reserve account, that will be the balancing figure. The difference comes is 416,200. Next one, equity share capital. The credit is heavier. Amount of credit total is 22,80,000. Writing same in the debit, 2280 and subtracting debit 13,20,000 is a closing balance of equity which will be going to our new balance sheet. 13,20,000. 8% preference shares already closed because they are no more there now in the market. 10% preference shares, a new one, 960 plus 240, 12 lakhs. So, two balance carried down. $12 lakhs. Last one, bank debited. Of course, if you see the overdraft which we wrote in the credit as opening balance is getting set off now because favorable balance is turning up, receipts are more. Debit side total is 14,40,000. That 1440 I am writing in the credit by balance carried down 416 minus 1440, find the difference. 10,24,000 will be our favorable bank balance coming in the current assets. Bank overdraft is nullified. So, that was a typical sum where question came out with a variety that prepared this many ledger accounts. Every time it was journal entry and balance sheet, journal and balance sheet. And this question came out with ledger and balance sheet plus that new typical way, valuation of investment, capitalization method of valuation of shares, that came out. Okay. So, all these typical adjustments you have to see before we go for the final exam in the auditorium. Okay. So, these typical things were there. One more point I like to discuss with you people for internal reconstruction in our classwork last question it is. Now, if you see our classwork last question, question number 9, it has some typical adjustments and that we are trying to discuss out. The first typicality is the adjustment number 1. It says paid up value of 7% preference shares is to be reduced. All the sums what you have done, every time face value was changing. Here they are changing the paid up value. So, care is to be taken while passing the entry. Same thing is for second adjustment. Paid up value of 7% preference share in the first adjustment and paid up value of equity shares in the second adjustment. So, these two paid up values are changing. So, entry will be directly preference share capital account debit to capital reduction, equity share capital account debit to capital reduction. It will not be something like old to new and then to capital reduction, no. Okay. Then it says about one another typical adjustment is this one. B 6% debenture holders agreed to take over Chennai Works. Chennai Works means Chennai factory at 4,25,000. Now, if you see the balance sheet, this Chennai Works, Chennai factory, book value is 775 and that is taken over only in what price? 4,25,000. So, this Chennai Works are taken over by debenture holders only at 425. Their actual value is 775. What does it mean? The value is coming down by 3,50,000. You see the liability, this B debentures, Chennai Works, to whom how much was paid or payable by us to them was 3,50,000. The amount due to them was 350. They took over our Chennai Works, Chennai factory at what price? 4,25,000. We were to pay them only 350. They took our asset of 4,25,000. So they took excess 75,000. What else? And to accept an allotment of 1500 equity share of 10 each at par. So along with our Chennai works, Chennai factory building, we are also giving them equity share of 15,000 rupees. So 75,000 extra towards the Chennai building or Chennai works plus 15,000 of equity shares, means in all we gave them an excess payment of 90,000 rupees, which they are likely to refund to us. How are they refunding? And upon their forming a company called Zia Limited, after they took over our Chennai works, those debenture holders, they took our Chennai factory building, and then they formed their own company called Zia Limited. And how are they refunding you 90,000? They allotted 9,000 equity shares of 10 each, fully paid at par to Star Limited. Star Limited is our company. So multiple things happening in this one. If we think of the journal entry here, they are B 6% debentures. So they are the receiver, debit the receiver. B 6% debentures account debit, they are 3,50,000. Right? They are taking over our Chennai works, and Chennai works is of 7,75,000, and they took it over at only and only what amount? 4,25,000. I can have a combined effect here also, like I can say 2 Chennai works amount is 7,75,000. Of course, reduction in the value is debited to capital reduction account. You can pass a separate entry also for that. Capital reduction 350. That value was coming down by 3,50,000. Then we are also giving them equity shares of 15,000. So 2 equity share capital account 15,000. So in all, we give them an excess payment of 90,000, which they are refunding back to us, and they are refunding it back in form of equity shares of Zia Limited. So for our company Star Limited, we are getting shares of Zia. It's a kind of investment coming in for us. Debit what comes in. So I'll debit investment in shares of Zia Limited account, debit 90,000. So this was the typical adjustment about settlement of B 6% debentures. One more adjustment to follow immediately after that. Adjustment number 7 is regarding workmen's compensation fund as well as asset side investment in workmen's compensation fund. Adjustment 7, it says Chennai Workmen's Compensation Fund disclosed that there was an actual liability of rupees 1,000 only. If you see the liability, Chennai Workmen Compensation Fund is rupees 5,000, but now out of this 5,000, actual liability remaining is only 1,000. That means other 4,000 is like our free reserve, which should be transferred to capital reduction account. So that entry will come for 4,000. It's a gain for us. So to capital reduction account 4,000. What I should debit is Chennai Workman Accident Compensation Fund account, debit 4,000. Got it, everyone? Then what else is given? After that 4,000, as a consequence, the investments of the fund were realized to the extent of balance. So, if you see the balance sheet of the sum, asset side investments are 15,000. There is no separate investment for Mumbai works and for Chennai works. It's combined investment 15,000. And what is question saying you? Out of 15,000 I must keep at least 1,000 rupees because there is a liability of 1,000 pending. Question says entire investments. Look at the word used, entire investments. Means a whole investment, but by default after whole investment 1,000 has to be kept by you. Your total investments are of 15,000. Still we keep 1,000. So you can sell investment of 14,000. What is given? Entire investments were sold at a profit of 10% of book value. So on 14,000, 10%, 1,400 profit. So we receive 15,400. Entry will be bank account debit 15,400 to Workman's Accident Compensation Fund investment account. Book value is 14,000. 1,400 is profit. So to capital reduction 1,400. And question also says in the same line that this sale proceeds, this 14,000, the proceeds were utilized for part payment to creditors. This 15,400 what our company received by selling investments will be paid off to creditors. So immediate next entry. You pay this 15,400 to creditors, they are the receiver, debit the receiver, entry. Creditors account debit to bank account or cash bank, whatever the word you want to use. 15,400. So this was that typical aspect. Okay. Of course, our classwork question is demanding only journal entries, but you people can very well practice in this sum of preparation of balance sheet also. You will observe some typicalities in preparation of balance sheet of this sum. I am just writing the totals of the different heads when you prepare a balance sheet, so that you can practice and verify that yes, you are getting answer or not. Like for share capital, it should be 8,35,000. Reserves and surplus, it is 133,800. Non-current liabilities are 3 lakhs. Current liabilities is 94,600. In total 1363,400. Non-current assets 773,400, and your current assets are 5,90,000. Your asset side total 1363,400. Balance sheet telling figure. So for practice purpose of yours, you can very well try making a balance sheet of this question number 9 of our class work. Name of the company is Star Limited. As I said you friends, enough number of sums available in our textbook. So many past paper sums, all past paper sum solution you can very well match. They are also available on ICA website. The care is to be taken by you is only one, that all typical points I have discussed with you, all those typical points should be there on your back side of the mind. And that typical sum of IPCC, preparation of different ledger accounts and valuation of investment has its own unique variety. So do refer to them properly, understand them thoroughly. Care to be taken by you in exams while touching internal reconstruction sum is about the speed. It's really very lengthy. 10 to 12 adjustments, that means equivalent number of journal entries with narrations. Very serious note, students many times create a habit of not writing narrations, and unfortunately that habit continues in exams. They write the solution without writing narration, and then leading to huge loss in terms of marks, huge loss. So don't create wrong habits, students. Make a habit of writing narration. At your home when you practice, write narration but in short form. But that habit should be there, that as soon as entry is over, immediately brackets should start being. So that will always remind you again and again in your mind that yes dear, you have to write narration, yes dear, you have to write narration. The length of the solution is the killer part of internal reconstruction. Balance sheet preparation, name of the company in the bracket you must write, and reduced. So all these typical points should be there on the back of your mind when you go ahead with internal reconstruction.